name is Bob Olson, and I'm the founder and president of the Robert Olson Wealth Group, a family wealth advisory firm that specializes in guiding clients through the dangers and complexities of today's financial world. We work primarily with the families of affluent older couples that are approaching or enjoying their retirement years. That means couples that are age 50 to age 70. We also work with a smaller group of successful younger families and single individuals as well. The vast majority of our clients are busy and active in a wide variety of areas and value the opportunity to delegate a large number of financial tasks to a trusted firm of wealth professionals. This doesn't mean that they give up any individual or personal control. It simply means that they're willing to assign the implementation of their financial goals to experts that specialize in taxes, investments, estate planning, and retirement-related money issues. I've been a practicing CPA for more than 35 years now. I'm also a certified financial planner, a registered investment advisor, and hold a number of other licenses and designations that all relate to our primary areas of practice, which are taxation. We implement strategies that minimize or eliminate income tax for our clients, especially in their retirement years. Most experts agree that because of the current level of excessive government spending and the demographic trends that are currently in place right now, taxes will most likely be increasing dramatically in the future. So this component of what we do for our clients is becoming more and more important. Investments. We manage, monitor, and optimize our clients' investment funds using proprietary investment models and methodologies so that our clients can rest easy knowing that their basic retirement income will never run out. They also benefit by being able to maximize their investment returns in good financial market conditions while minimizing losses, risk, and volatility in bad market conditions. Estate planning. We craft and implement custom-designed estate plans for each of our clients. With a written estate plan in place, everyone has a much higher chance of success when it comes to passing on their financial legacy with a minimum of time, cost, and heartache. Retirement strategies. We help our clients maximize their Social Security retirement benefits, which is the foundation for all retirement income planning. We then allocate and rebalance our clients' financial assets so that a series of income sources are created that will provide our clients with monthly income that they will never run out of. In short, we assist our clients to build and preserve their family's wealth so they can live their lives with dignity and without financial worry. So how do we accomplish all of this? We accomplish these objectives through a series of unique concepts and frameworks that we've developed over the years. The presentation that I'm about to share with you deals with the investment piece of a family's wealth picture. This video discusses our overall investment philosophy and reviews the big picture about how investments are typically chosen and how we do things differently. I've created a series of additional presentations on the specific investment models and methodologies that we are currently using. So please feel free to browse through the video page of our website for these other presentations. One final note before we get started. This presentation is primarily educational in nature. It is designed and crafted for our existing clients who are seeking some additional information or a refresher on how we invest client funds, and it's also designed for our prospective clients that would like to gather some additional information on our investment philosophy and unique methodologies. There's no sales pitch, nothing to buy, and no need for you to pull out your credit card. So rest easy and just sit back, listen, and enjoy the presentation. Let's get right down to work. I refer to this particular concept as fact-based investing. And believe it or not, it is quite different than the philosophy used by the vast majority of Wall Street-based investment advisors. When the gates are all down and the signals are flashing, and the whistle is screaming in vain, and you stay on the tracks, ignoring the facts, well, you can't blame the wreck on the train. These are some very fascinating lyrics from a song that was recorded and released in 1987 by a singer-songwriter by the name of Don McLean, called You Can't Blame the Train. And I believe it applies to investing just as much as it does to life in general. Today we're going to focus purely on facts as they relate to personal investing. We're going to look at an approach that I call fact-based investing and compare and contrast this philosophy to other approaches you may be familiar with already. For a very, very long time now, many investors have felt lost at sea, sometimes for extended periods of time during their investing lives. The major indexes like the Dow, the S&P 500, and the NASDAQ essentially went nowhere for the entire decade of 2000 to 2009, to say nothing of the two massive declines of more than 50% that occurred during that decade. And the fear that was inflicted on investors has caused many of them to flee the investing markets and not fully participate in the vigorous recoveries in the market since. Many investors have felt that their portfolios, represented by these pie charts, are being tossed about by whatever storm passes through the markets. In other words, adrift with not enough progress due to either an overexposure to equities during bad times or an underexposure to equities in good times. So how did we get to this point? Here's a quote from Albert Einstein that is right on target. He said, quote, "The definition of insanity is doing the same thing over and over again and expecting a different result." Many investors have certainly been doing the same things over and over again, yet expecting a different result. The vast majority of advice that investors have received for the last several decades has been created from predictions about what might occur in the future and theories about what should occur in the future. First, let's look at predictions. Predictions come in many forms, and I use 4 of these forms to create an acronym: predictions, opinions, outlooks, and forecasts form the acronym POOF, which reminds us of how dangerous predictions can be. Everywhere you turn these days, you can find predictions telling you with great confidence what the financial markets are going to do. From books, magazines, newspapers, TV, websites, blogs, to friends, neighbors, and relatives. Everybody, it seems, has some sort of market prediction. Here are a couple of books that were actually bestsellers in 1999. The authors, with perfectly sound reasoning, predicted that the Dow Jones Industrial Average would continuously climb higher and higher, reaching 36,000 by 2005, and 100,000 just a few years later. Kiplinger magazine called Dow 36,000, quote, rock-solid investing advice. Many investors believed those predictions wholeheartedly and invested accordingly. Predictions, opinions, outlooks, and forecasts, POOF, are embedded in practically every segment that's broadcast on the financial news channels. Guests on CNBC are all knowledgeable, well-spoken, completely rational, and, unfortunately, frequently wrong. Here is a sampling of what was said in 2008, when investors desperately needed quality guidance the most. Even many CEOs, who should know more than anyone about the prospects for their own companies, turned out to be tragically wrong. Supposedly objective analysts like Larry Kudlow in the upper right-hand corner and the Financial Times guy in the lower left corner, were terribly wrong. And Jim Cramer, screaming at us to buy, 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 well, the best you could say about that prediction is that it was wrong, wrong, wrong. One thing they all have in common is complete self-confidence in their predictions about what was going to happen. The other thing they all have in common is that they were completely, terribly wrong. For years, Businessweek magazine's last issue of the year contained a feature in which market forecasters gave their predictions for the upcoming year. Here are their predictions for the S&P 500 for 2008, published on the very last day of 2007. In other words, these predictions were for the year that began the very next day. So it's not exactly a group of long-range predictions. In spite of that, of these 13 well-known, high-profile, and highly paid forecasters, 11 predicted a positive 2008, and some even a great 2008. One predicted a slightly down 2008, and the most negative prediction suggested just a modest decline, only 8%. The average prediction was for almost a 10% gain. The actual result of the S&P 500 index was negative 38.5%. So to say they were a bit off the mark is a pretty significant understatement. Yet investors by the millions continue to hang on every word uttered by this elite group of market gurus. Are the predictions of market experts and forecasters usually right? Or are we just picking on them by displaying a handful of rare and unusual misfires? Not according to a study reported on by the Wall Street Journal in October of 2010. Professor Philip Tetlock of the University of Pennsylvania studied 20 years of predictions from 284 experts in the fields of politics and finance, which of course includes the stock market, and carefully cataloged the outcomes of a staggering 82,361 predictions. He concluded that experts are wrong more often than right, and would have done better by simply flipping a coin. He further found that the more academic degrees the experts had, the more likely their predictions were to be wrong, and even worse, to stay wrong, evidently because they think so much of their own opinions that they refuse to change them, even in the face of facts to the contrary. So, sadly, misfires in predicting, even from highly paid experts, seem to be the rule, not the exception. As a matter of fact, I receive product pitches for newsletters, subscription services, and products that all pretend to be able to predict the future, like this one from a big-name investment firm. Quote, "Where is the stock market headed? If you have a $500,000 portfolio, you should download the latest report that tells you where we think the stock market is headed and why." Yes, that's compelling copy, but really just another forecast or prediction. The noted economist, author, and presidential economic advisor, John Kenneth Galbraith, who served in a variety of economic and diplomatic roles in Washington, D.C. administrations, from Franklin Roosevelt to Lyndon Johnson, said, quote, "The only function of economic forecasting is to make astrology look respectable." Edgar Fiedler, an assistant secretary of the Treasury during the Jimmy Carter years, had the final word on crystal balls when he said, quote, "He who lives by the crystal ball soon learns to eat ground glass." We could probably say investors who believe in crystal balls will soon learn to eat ground glass. A very wise Yiddish proverb has this to say about the futility of trying to know the future. Quote, "Man plans and God laughs." We could easily modify that just a bit to say, "Man predicts and God laughs." So, I believe we can safely conclude that the acronym POOF is very appropriate for predictions, opinions, outlooks, and forecasts. The other major source of investing strategies and advice are academic theories. We refer to this category of advice as theory-based investing. Chief among the academic theories that drive investing advice are the efficient market hypothesis, the rational investor theory, modern portfolio theory, the efficient frontier, strategic asset allocation, known to many investors as the pie chart. What all of these have in common is that each of them states what ought to happen and how financial markets and investors ought to behave, based on theoretical models and equations. It seems to make perfect sense, doesn't it? Naturally, knowing what risks you are undertaking is an essential part of any investing activity. But what exactly is risk when we're discussing investments? Most investors would agree that investment risk is the chance or probability of incurring a substantial loss, like you might suffer during a bear market. But, surprise, surprise, academics don't agree with that common sense view at all. The academic definition of investment risk is, in fact, quite different. This chart represents the performance of two hypothetical investments. The upper purple line is trending upward, but has experienced larger bounces and more volatility along the way. The lower blue line is trending downward, but experiences smaller bounces and lower volatility along the way. Academics call these bounces variances, and their statistical measurement is referred to as standard deviation. In academic investing theory, risk is frequently measured by standard deviation. The higher the standard deviation of an investment, the higher the risk. The lower the standard deviation, the lower the risk. Because the downward trending line on this chart has a lower standard deviation, most academic definitions would imply that it is less risky, even though it is currently trending downward. And, counterintuitively, by the same definition, the upward trending line might be considered to be more risky and presumably less desirable, even though it is currently trending upward. This comparison of investment risk with standard deviation, seemingly at odds with the common sense perception of risk as simply the chance of losing money, has nonetheless been a major factor in the creation of millions of pie charts, the ones that have guided many investors for years and continue to significantly influence investor behavior. For example, here is a pie chart typical of those created in the last decade for investors intending to retire in about 20 to 25 years. In other words, investors now in their early 40s. As you can see, if we add up the small cap, mid cap, and large cap pieces of pie, 71 cents out of every dollar invested with this pie chart is invested in U.S. equities. The remaining 29 cents are invested in international equities, bonds, and cash. This allocation was taken from a mutual fund called the Fidelity Freedom 2035 Fund in June of 2005, the midway point of that decade. Of the 71% portion that was invested in U.S. equities, almost 90% of those dollars were placed in large capitalization stocks, Only very tiny portions of the U.S. holdings are left over for small cap and mid cap stocks. The reason for this huge disparity is simple. Large caps have a lower standard deviation than mid caps and small caps. And so, programs and formulas that design the pie chart allocations automatically give an oversized portion to the allegedly less risky slices, which are the large cap pieces. Well, you've probably already guessed how that turned out. Sure enough, the supposedly lower risk, large cap portions all lost money for the entire decade of December 31st, 1999 to December 31st, 2009. And the tiny slices given to the supposedly higher risk mid cap and small cap made money with very nice returns for the decade. But, of course, the large cap allocations completely overwhelmed the tiny mid cap and small cap allocations, resulting in a loss for the entire U.S. equity portion of the pie, handing investors what the financial press has referred to as a lost decade. Perhaps most surprisingly, even at the conclusion of such a decade, large caps were still classified as lower risk than mid caps and small caps, based largely on academic notions that risk equals standard deviation. Even though large caps lost money for the decade, they did so with a lower standard deviation. Another one of the most widely followed academic theories is that diversification protects investors in declining markets. The idea is that different investments will march to the beats of different drummers, and so, theoretically, while some asset classes are going down, others might be going up. Once again, that seems to make perfect sense, at least on the surface. This chart shows that diversification across 9 non-fixed income asset classes works pretty well in a bull market, producing a very wide dispersion of returns, almost 300% from top to bottom. Even though all these asset classes were generally trending upward, they definitely went up at different rates, providing the desired diversification of returns. However, in the bear market that followed, the dispersion of returns collapsed dramatically. The supposed benefits of diversification across these 9 asset classes just wasn't there. An almost 300% difference of returns during the bull market shrank to a tiny 15% dispersion of returns during the bear market. This collapse of dispersion means that the correlation of the returns among these asset classes skyrocketed. Correlation is defined as the tendency of one asset class to behave exactly like another. A correlation of 1 would imply that 2 asset classes behave identically to one another. A correlation of between 0.1 and 0.9 would imply that the 2 asset classes act contrary to or differently from each other. This chart, once again, just proves the wise old Wall Street adage, quote, "The only thing that goes up in a down market is correlation." Alan Greenspan, America's chief economist during his 20-year tenure as Federal Reserve Chairman, was forced to admit that the academic theories underpinning his work were flawed, and that he greatly underestimated the market's ability to regulate itself and mitigate the terrible losses seen in 2008. Another well-respected economist, Professor Robert Shiller of Yale University, is now leading the way in blowing big holes in some of the investing world's dominant academic theories. He says bluntly, quote, "The efficient markets theory represents one of the most remarkable errors in the history of economic thought." Since the history of economic thought goes back at least 1,000 years, that's really saying something. The Financial Crisis Inquiry Commission was established by Congress in 2009 to study and report on the causes of the most recent financial crisis. The commission interviewed billionaire investor George Soros, and the interview was short and blunt. Soros stated that the academic theories believed in by both regulators and investors, quote, proved to be false. Specifically, he blamed the belief in the efficient market hypothesis and the rational expectations theory, not just for making the crisis worse, but for actually being the principal cause of the crisis. The Myth of the Rational Market, published in 2009, relates in great detail the origins and history of the major academic investing theories. As the title implies, the author concluded that those theories are myths. One of the surprising revelations in the book is that academics stubbornly stuck with flawed theories, even when faced with substantial evidence to the contrary, largely because their flawed theories were mathematically modelable and nicely fit their existing equations. They seem to prefer the neat and tidy models and equations that define their flawed theories to the more messy and chaotic market realities which might resist mathematical modeling. In summary, we have good reason to reject both prediction-based investing and theory-based investing. But what can we turn to instead? Is there a better way? Well, let's revisit that great Don McLean lyric. I believe that facts are as useful in the stock market as they are at the railroad crossing. I call our approach fact-based investing, in contrast to the prediction-based and academic theory-based methods we've just looked at. Here are three major characteristics of fact-based investing. First, and most importantly, there are no predictions in fact-based investing. We get our marching orders instead from what is, and not from the prediction-oriented what might be. Second, fact-based investing makes no assumptions about market efficiency or rationality. Fact-based investing embraces the reality of inefficient and irrational markets and tries to use those characteristics to our unfair advantage. Third, fact-based investing does not remain fully invested regardless of market circumstances. So, when the lights are flashing, the gates are down, and the whistle is blowing in vain, we get the heck off the track and out of the market. The focus of fact-based investing is entirely on careful measurements of what actually is, rather than emphasizing the predictions of what might happen tomorrow or the theories of what ought to happen tomorrow. I zero in on measurements that reflect the continuous tug-of-war between supply and demand. I believe that every single tick in the market and every trend results from imbalances in supply and demand. After all, if there were no imbalances of supply and demand, prices wouldn't budge at all. And longer-running trends are, in my view, driven by longer-term imbalances in supply and demand. From my supply and demand analysis, I arrive at two truths about the market. The first of these truths, generated from supply and demand, is that markets trend, and frequently trend for years at a time. Trends can occur in any time frame, from intraday to multi-decade. The most useful trends for me are those that last from months to years at a time, commonly known as bull markets and bear markets. And the fact that markets are irrational and prone to excesses can actually work to our advantage, because irrationality typically extends trends, both up and down. A great example of how irrationality can extend a trend occurred in the late 1990s. On December 5, 1996, Alan Greenspan gave his famous Irrational Exuberance speech to the Economics Club of Washington, D.C. In that speech, he identified U.S. tech stocks and Tokyo real estate as displaying irrational exuberance. On that day, the tech-heavy NASDAQ 100 closed at 835.8. Paying no attention to Mr. Greenspan, demand, irrational or not, powered the NASDAQ 100 to an astounding five-fold increase before finally topping out at 4,704 in March of 2000, more than 3 years later. At the other extreme, bear markets frequently go lower than rational analysis suggests, as panic selling and other irrational get me the heck out of here behavior steepens the decline in a bear market. This is a 115-year view of the U.S. stock market. It clearly shows that the market benefits from multi-year periods of dramatically rising prices called secular bull markets, followed by multi-year periods during which the market suffers from big hits or goes nowhere at all. These are called secular bear markets. In secular bull markets, demand is clearly and conspicuously in control, whereas in secular bear markets, supply and demand fight a seesaw battle, with each gaining the upper hand for short periods of time. During a secular bear market, it is very difficult for a buy and hold investor to do well. But for fact-based investing, there can be opportunities. Let's zero in on the go-nowhere period of the most recent secular bear market, the period from 2000 through 2013. Even there, in a period when the S&P 500 produced no net gains, for more than 10 years, there were two distinct downtrends, 2001 through 2002 and 2008 through 2009, and two distinct uptrends, 2003 through 2007 and 2009 through 2011, ranging in duration from 1.5 to 5 years each. These are called cyclical bull markets and cyclical bear markets, known popularly as simply bull markets and bear markets. Our fact-based investing methodology seeks to identify and capitalize on these kinds of bull and bear trends in order to profit from them. The second truth developed from supply and demand analysis applies to the selection of portfolio components. In fact-based investing, the selection of portfolio components is based upon the tendency of performance to persist. Researchers have labeled this phenomenon as momentum and have documented its widespread existence in the markets over a span of many, many decades. In his first law of motion, sometimes referred to as the law of inertia, Sir Isaac Newton said that an object at rest stays at rest, and an object in motion stays in motion, with the same speed and in the same direction, unless acted upon by an unbalanced force. Similarly, in the stock market, high performance has been shown to be more likely to continue than to reverse at any given time. The same holds true for low performance. It too has been shown to be more likely to continue than to reverse at any given time. Using continuous measurements, fact-based investing simply selects high performers and excludes low performers. Fact-based investing makes no attempt to predict future changes or the next big thing. Instead, fact-based investing relies on careful measurements of actual performance to guide portfolio construction. Our implementation of a fact-based strategy requires just two kinds of tools: tools to identify bull and bear trends, and tools to identify high-performance portfolio candidates. Here is our primary tool for identifying major trends, called the bull-bear indicator. The job of the bull-bear indicator is to determine when a new bull market or a new bear market has emerged. Once again, this is a measurement of what actually is, with no predictions or academic theories involved. Our goal is to be defensive and protected in bear markets, and to be fully invested during bull markets. The second tool of our fact-based strategy seeks to identify high-performance portfolio candidates. Momentum, relative strength, rate of change, nearness to 52-week highs, and other measurements of performance characteristics are all combined to produce rankings of portfolio candidates. High performers are selected, low performers are discarded, and the whole process is repeated at regular intervals, usually monthly or quarterly. This process of continuous self-renewal and rebalancing is intended to capture the benefits of long-term winners without being dragged down by the unnecessary inclusion of underperformers. Combining these two tools gives us a simple yet complete strategy, providing guidance on when to be defensive and when to be offensive, and when we are offensive, how to construct high-performance portfolios. Fact-based investing, concentrating on the what actually is of market supply and demand, rejects the what might be of prediction-based investing and the what ought to be of theory-based investing. By combining trend identification and high-performance portfolio selection, our fact-based investing strategy gives us what we believe to be the best chance of achieving our twin goals: to prosper in bull markets and to be protected in bear markets. Well, that's it for now. I hope you've enjoyed this brief discussion about fact-based investing and how it could make a major difference in your financial future. Feel free to browse around our website on the video pages for new and updated content if you're looking for more. This is the standard disclaimer page that I need to provide you with, so go ahead and read it quickly if you'd like. It basically says that the information in this presentation is general in nature, and if you'd like to implement any of these concepts, you should seek out a trained professional to craft a specific program to your individual needs. It also says that there are no guarantees in the financial markets. I think everybody understands that one. We'll talk a little bit more about guarantees and where to get those in some of my other presentations. So for now, thanks for watching and listening. I hope this information has been helpful. If you like what you saw, I have a lot more. I will be releasing new video presentations periodically and updating the old ones as well. If you'd like to get access to this educational information, make sure you provide me with your name and email address, and I'll add you to a special list I've created so that you can receive priority notifications about new educational content when it becomes available. You can do this by making your way back to the home page of our website and completing the Join Our Free Email List box in the upper right-hand corner. Thanks again for watching and for listening. I'll talk to you soon.